Today, UK inflation still not beaten as wages spiral for some. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Well, UK inflation remained higher than expected last month as the cost of travel and holidays climbed, adding to the case that the Bank of England will need to raise interest rates again, this despite an expected fall in energy prices. The Consumer Prices Index rose 6.8% in July, exceeding the 6.7% rate expected by economists, according to the Office of National Statistics. It was the fifth time in 6 months the figure surprised on the upside. Inflation remains more than triple the Bank of England's 2% target. While falling energy and food price inflation brought the headline rate down from 7.9% in June, the cost of services accelerated by 0.2 percentage points to 7.4%, matching highs touched in May and back in 1992. The price of airline tickets and hotels increased rapidly, and there was also a 1.7% increase in the cost of renting property, mainly from state-supported housing. The core rate of inflation, excluding food and energy prices, held at 6.9% in July, instead of ticking down as economists had expected. For low-income households that tend to spend more of their income on food bills, there was some good news as the rate of food inflation slowed, but it's still high at 14.9%, and it was the slowest growth rate since September 2022. Basics such as milk, breakfast cereals, bread and crumpets drove the fall, and 10 of the 11 detailed food classes saw a fall in inflation. 3 of those 10 classes saw prices fall between June and July. Now, the Resolution Foundation noted that the fall in inflation from 10.1% in January was the sharpest for 6 months since September 1992. Inflationary pressures subsided in the manufacturing sector, with raw material costs continuing to decline, raising the prospect of further falls in inflation in the coming months. Prices charged for goods leaving the factory gate fell 0.8% in the year to July. That's the first negative reading since December 2020 and the lowest since October 2020. Coupled with a record surge in wages reported on Tuesday and surprisingly strong growth, the figures strengthen the sense that Britain is suffering the worst inflationary spiral in the group of 7 nations. Investors have revived speculation the Bank of England will deliver a quarterly point rate hike or more next month. It's worth reflecting on this, that Britain has suffered the worst inflation in the G7 since the start of the pandemic. The latest inflation figures were 5.3% in the Eurozone, 3.2% in the US and 3.3% in Japan. Prime Minister Rishi Sunak's government has made fighting inflation a priority ahead of the election that's widely expected next year. While price rises are slowing, we're not at the finishing line, Chancellor of the Exchequer Jeremy Hunt said. We must stick to our plan to halve inflation this year and get it back to the 2% target as soon as possible. Of course, the truth is that the fall in inflation is on autopilot, particularly thanks to falling energy. So, to an extent, the government really has done very little to help. The stubbornness of core inflation and services inflation in the July CPI print actually will only stand to reaffirm concerns at the Bank of England about the persistence of price pressures. With wage growth still running red hot, the prospect of a more meaningful cooling in domestically generated inflation remains, well, a very distant prospect. So we think it's likely to prompt the central bank to lift rates in September and maybe November. Heidi Karjalainen, a research economist at the Institute of Fiscal Studies, said the government's goal to cut inflation in half this year is actually a risk. There is only so much the Treasury can do to influence the pace of price increases, she said. With only 4 months to go, it no longer seems at all clear that inflation at the end of the year will have fallen by enough to achieve it. That said, pay is on track to be rising faster than CPI inflation for the first time since October 2021, after a sharp fall in inflation in July provided households some long-awaited respite in the cost of living crisis. Regular pay, excluding bonuses, increased 7.8% in June, and is expected to exceed the current 6.8% headline rate of inflation in next month's official release. Households have suffered a severe real terms income squeeze since energy prices started rising, even before Russia's invasion of Ukraine last year. At its lowest point in June 2022, real annual wages growth had contracted 4.1%. The market, for the most part, shrugged off the release, though. Traders had already ramped up bets on further hikes on Tuesday, after data had showed that wages were rising at a record pace, so they're pricing in another 75 basis points of increase to 6% by March next year. Bonds were little changed, while the pound edged up after the release. Sterling climbed by as much as 0.2% to 1.2732 against the US dollar, and that means that it will probably have a second day of gains. But 2 quick points. The first is that inflation is still significantly high, and for those who are putting most of their income to covering the cost of where they live, be it either rent or a mortgage, and also buying food, then inflation is much higher than the average. And on the other hand, those wage rise increases are not spread evenly across everyone. There are some that are doing very well and some doing less well. So the bottom line is this, that we have to expect the inflationary pressures to continue to force the Bank of England to lift rates higher, and they'll be holding rates higher for longer. Therefore, growth will be anemic, and therefore the stock market is overvalued. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.